Welcome to another technical analysis training video. My name is Samuel Morton, and in this video we're going to look at moving averages. So far in this course we've looked at how price behaves when it uptrends, when it downtrends, and when it ranges. We've looked at the patterns that price creates in the market. We've looked at Japanese candlesticks, more specifically engulfing candles and pin bars, and how these types of candles can help us to trade uptrends, downtrends, and ranging markets. I think this is a good time now to talk about moving averages and how they can help us to trade with the trend. Just like engulfing candles and pin bars, moving averages can help us to identify a trend and help us join a trend. So what is a moving average? I think even the most basic mathematicians among us know what an average is. We have a series of numbers such as 1, 2, 3. And an average is determined generally by the center number, or by adding all the numbers together and then dividing by the number of numbers. So this is 6 divided by the 3 numbers gives us 2. So how does a moving average differ? Well, a moving average takes a series of numbers like so, and is determined by the period or length of the moving average. If we were to have a moving average set at 4, so a period of 4, it would take the last 4 numbers in our series and calculate the average. If we had a moving average where the period was 6, then we would take the last 6 numbers and calculate the average. When we use moving averages on price graphs, a moving average will look something like this red line on our graph. This is a moving average at the period of 25. So at the end of each candlestick, an average is calculated by the past 25 candlesticks, and the number which is used is generally the closing price of a candle. So with this moving average at this point, from here 25 candles back, the closing price is averaged and plotted on the graph. And when this is done with each candle, we get a moving average. So how can a moving average help us when trading? Well, there are 2 very basic ways we can use a moving average. First of all, if we have a single moving average on our graph, it can show us the overall bias or direction in the market, a bullish or bearish bias. You'll see that this moving average is heading down or in a downwards direction, and then starts to go up here. You'll notice that price also behaves the same way. Coming to the end of this uptrend, our moving average starts to drop just around here, which is the end of this uptrend. We now have a downtrend. Price is downtrending. Our moving average is heading down, showing us that price is in a downwards direction. And the moving average starts to change direction and head in an upwards direction just around here, the end of this trend, before price does head on the upside. Another way a moving average is used is by what traders refer to as a crossover, or a moving average crossover. And that's done by taking two moving averages set at different periods So I have a moving average set at 25 and 35. The moving average set at a lower period of 25 is considered the fast or faster moving average, whilst the moving average set at 35 is considered a slow or slower moving average. When our fast moving average, which is green, is above our slow moving average, we can take this as a signal that price is going to appreciate. When our slow moving average is above the faster moving average, we could take this as a signal that price will depreciate. And the way the moving average crossover system works is when these moving averages cross over, it can act as a signal that price is going to change direction. For example, we are on a downtrend here. Our red moving average is above the green, meaning price is depreciating. Our crossover is right here. The green goes above the moving average from being below, and price changes direction. At the end of this uptrend and the start of a downtrend, we have the crossover here. Price is uptrending and then starts downtrending. Once again, we have our crossover. Price is downtrending, then price starts uptrending, and we have our crossover. These moving average crossovers work far better on trending markets than ranging markets. If we go to the range we have been using in these videos, you'll see that we still get these crossovers, and price generally does follow the slower or faster moving average, but overall price is moving in a sideways direction. And moving averages used on a crossover method generally are not to be trusted when price is moving sideways.